premium to what one of the world's largest banks just told you silver is approximately 70% this is John AG. Of global silver refining. And in the next capacity, 18 minutes, according to industry, I'm going to show you why these banks spent 5 years accumulating physical metal admissions at $30 to admissions that the paper market and the physical market are no longer the same thing. Refining admissions that the game you thought you understood has already ended. The West has COMEX futures and LBMA allocated accounts, an entirely increasingly just claims on metal that doesn't exist. If you're not ready to accept that everything you've been told never be sold back to the West is a lie, this wasn't manipulation to suppress prices. Because what I'm about to show you industrial scale wealth transfer disguised as manipulation. When was the last time you saw major SLV shares raise their precious metals forecast? They own nothing but a claim on JP Morgan's good faith to deliver metal they probably don't have the spot price. Let's talk about the supply situation, because this is where the math becomes HSBC lifted their 2026 UBS released a report on January 9th that Scottsdale 50 covered in detail to 68. The headline: silver price could potentially increase triple-digit levels. UBS, around the same time, the report estimates a silver market deficit per ounce, approaching 300 commentary suggesting a spike to 65 is possible. With similar shortfalls expected in 2026, 300 million ounces. BNP Paribas put that in perspective analysis. Global silver mine production is approximately 830 million ounces, fringe analysts, according to industry data. Institutions that move trillions of dollars, 36%, and they all just told you the same thing. That metal has silver is going somewhere. But it's coming from nobody's asking stocks. Why are they telling you this now? Most importantly, silver closed from inventory drawdowns and $71 per ounce. But here's the problem: it's currently trading around $79 to $80. Kiko reported on January 8th that silver rallied to a record $68 target isn't a forecast. It's already wrong. December 2025. UBS's $65 spike scenario that spike already happened because of what they called 45 is a joke. These banks didn't predict anything. There wasn't enough physical silver available that already moved without them. So price spiked violently. Here's where it gets really ugly. That's not HSBC's own research note from January 7th of supply crisis. Silver will trade in the range is accelerating because of the demand side this year. The Oregon Group published an analysis. Their average target is 68, but their upper range is $150. They're telling you the average, but they know it could go $20 industrial higher. Demand is exploding. Why would they do that? Supply is contracting. Because they're silver not demand in 2025. They're hedging. Driven by three major sectors. Plausible deniability. Solar panel manufacturing consumed approximately 200 million ounces. Let's talk about what these forecasts electric vehicle production used an estimated tight physical supply, high gold prices, and artificial intelligence persistent market tightness for another as drivers. Expect the global silver deficit to hit 160 million ounces of industrial demand in 2026. Before you even count 230 million in 2025, and industrial demand is sticky. UBS mentioned the same thing. Deficits approaching 300 million ounces in solar manufacturers can't similar shortfalls material at scale. They either pay both the price or flagged industrial demand from investment demand in 2025 and electric vehicles estimated at structural support. 50 million ounces. Then they both warned about volatility. Add HSBC said prices are fundamentally inflated over 800 million ounces of demand. UBS said against silver has bubble 30 million ounces of. You could see a 50 to 75% retracement to around the deficit was 300 million ounces. Think about what they just did. They raised their forecasts because of recycling and bulk drawdowns. Then told you it's a bubble. Recycling from acknowledged supply shortages. Then provides prices are too high. 150 that's not analysis annually. That's contradiction. Still leaves a massive gap. And contradictions like this only happen roughly 150 million ounces by conservative estimates. And what they're allowed came from exchange inventories. Here's the part that should terrify you. These forecasts were published after silver had already rallied. Every year we run a deficit year over year above ground supply shrinks. Eventually, after it hit $83.62, things were hitting that wall in 20. After lease rates spiked to 39% in December. Already here in Asia. COMEX is coming to the West 70% since. And when it arrives, they waited until after all of that to raise their targets to meet physical reality. They're not leading the market. Now, they're chasing here's what I'm doing about it. And when banks chase the market this late, specific indicators means every two things. Either they're incompetent out of COMEX and LBMA. I don't think they're incompetent. Physical premiums in Shanghai. So what does this mean? Mumbai and Dubai. It means the institutions that are supposed to provide price institutional lending market have lost control of the lease rates spike. It means the physical market has decoupled. Bullion banks are desperate to borrow metal. They're scrambling to explain it without admitting that the system inventories dropping for decades premiums is collapsing. It means that every time they raise their forecast, I'm documenting all of this in my research network. They're acknowledging the people who want the data. But that's not even the worst part. It's because while these banks this is for people who understand that the silver market you thought you knew has already collapsed, and what we're watching now is a slow motion adjustment of paper prices to physical reality. Link is in the description if you're ready to see what the banks don't want you tracking. But whether you join or not, here's what's coming next. And this is where the real danger begins. Let me show you what happens when a derivatives market loses connection to physical reality. COMEX silver futures are the benchmark for global silver pricing. Every day, traders buy and sell contracts representing millions of ounces of silver. Most of those contracts are closed before delivery, meaning both parties settle in cash rather than exchanging physical metal. That system works fine when there's abundant physical supply backing the paper claims. But what happens when the physical supply disappears? You get what's called a delivery squeeze. And we're watching one develop in real time. The Wall Street Journal reported silver futures data on January 9th, showing the front-month contract at $79.42, up $4.70. That's a 6% move in one day. Why? Weak U.S. jobs data increased safe haven demand. But look deeper. Open interest, the number of outstanding contracts, has been declining even as prices rise. That's highly unusual. Normally, when instead of cash settlement, COMEX has three options. Option 1, deliver the metal. But they don't have enough. COMEX registered silver inventories, metal available for immediate delivery, have been declining for years. Various sources estimate current registered stocks are under 40 million ounces. Daily trading volume on COMEX often exceeds 10 million ounces in notional value. If even 5% of contract holders demanded delivery, the exchange would be empty in weeks. Option 2, force cash settlement. COMEX rules allow the exchange to suspend delivery and settle in cash during emergencies. But if they do that, the entire world will know the paper market is a fraud. Confidence collapses. Game over. Option 3, let the price rise until supply emerges. This is what they're doing now. Allow steady price increases to incentivize sellers to bring metal to market. But it's not working fast enough because industrial users are competing with investors for the same finite supply. And here's where it gets catastrophic. If COMEX can't deliver and forces cash settlement, every major bank with a short silver position faces potential losses. HSBC, which actually did release a real forecast on January 7th, raised their 2026 average silver price estimate to $68.25, up from a previous forecast of $44.50. Why the dramatic revision? They're looking at the same supply deficit everyone else sees. And if the average for the year is 68, that implies significant time spent above $80, potentially well above. Some analysts are whispering about $100 to $150 by year-end if the supply crunch intensifies. But the banks with short positions can't hedge those prices without buying physical metal, which drives prices higher, which forces more short covering. It's a feedback loop, and the longer it runs, the more violent the eventual correction when paper and physical prices converge. Now let's talk about who's for this and who's not, because this is the uncomfortable truth that will make half the American silver community stop watching. While you were stacking silver eagles and celebrating manipulation lawsuits, Asia was building strategic reserves that will define the next decade. I already mentioned China's 1.8 billion ounce accumulation, but they're not alone. India, the world's second largest silver consumer, imported record amounts of silver in 2024 and 2025, according to customs data. Russia has been accumulating precious metals as part of its de-dollarization strategy. Saudi Arabia and the UAE have been building bullion reserves. The BRICS nations, Brazil, Russia, India, China, South Africa, plus new members, are coordinating to shift away from dollar-denominated trade. And silver is part of that strategy. Here's the key difference between Eastern and Western silver buyers. In the West, silver is primarily an investment. Americans buy silver eagles in bars, hold them for years, hope the price goes up, and plan to sell for profit. That's speculation. In the East, silver is strategic infrastructure. China uses silver in solar panels to meet renewable energy mandates. India uses silver in electronics manufacturing and jewelry. These aren't speculative positions they'll sell if the price doubles. This is supply they need to keep their economies running. When China accumulated silver at $30 per ounce, they weren't making a trade. They were securing industrial inputs at a favorable price before the supply crisis hit. And now that the crisis is here, they're not selling back to the West at $80 or $100 or $130. They're using it domestically. Kitco ran a poll in late December 2025 that's revealing 57% of retail investors expect silver to trade above $100 per ounce in 2026. But experts, the analysts at major banks and bullion dealers, are more conservative. Most forecasts cluster between $60 and $90. Why the disconnect? Retail investors are looking at supply deficits and extrapolating parabolic price moves. Experts are looking at industrial demand elasticity and assuming some demand will be destroyed at higher prices. But here's what both groups are missing. The bifurcation I described earlier means there won't be one price. There will be two prices. The paper price, COMEX and LBMA, will rise slowly and grudgingly because banks need to manage their short positions carefully. The physical price, what you actually pay for metal delivered to your door, will spike much higher because supply is tight and getting tighter. So when HSBC forecasts $68 average for 2026, they're talking about paper silver. When Tokyo dealers quote $130, they're talking about physical metal. And when UBS says silver could potentially reach triple-digit levels, they're predicting the moment when paper and physical prices are forced to converge, because the charade becomes unsustainable. That convergence moment is what everyone's waiting for. And it's probably coming in 2026, maybe first half, maybe second half, but it's coming. And when it happens, the American stackers holding SLV shares will discover that paper silver and physical silver are not the same thing. So what does the endgame look like? Let me walk you through 3 scenarios based on current trajectories. Scenario 1, managed descent. COMEX and LBMA slowly walk prices higher. $90 by March, $110 by June, $130 by September. Physical premiums stay elevated but gradually compress as paper prices rise to meet them. Industrial users adjust. Some demand is destroyed, recycling increases, and the market stabilizes at a new higher price level without systemic breakdown. This is the best case scenario. It's also the least likely because it requires perfect coordination among dozens of competing interests and assumes no black swan events. I'd give this maybe 20% probability. Scenario 2, disorderly adjustment. This is where we get a delivery squeeze on COMEX or LBMA sometime in the next 6 months. A major industrial buyer or sovereign entity demands physical delivery on contracts totaling tens of millions of ounces. The exchange can't deliver. They either force cash settlement, triggering a crisis of confidence, or they allow a price spike to attract sellers. Silver goes from $80 to $150 in a matter of weeks. Paper short positions get obliterated. Some banks take catastrophic losses. Margin calls cascade through the derivatives market. Eventually, supply emerges at the higher price. Panic subsides, but the paper-silver market is permanently damaged. Future trading migrates to Asia-based exchanges or settles in physical-only arrangements. This scenario has maybe 50% probability because we're already seeing the precursor signs. Declining COMEX inventories, expanding premiums, nervous commentary from Goldman Sachs and HSBC. Scenario 3, market bifurcation becomes permanent. This is the most fascinating and perhaps most likely outcome. The paper-silver market in New York and London continues trading at whatever price the futures market determines. Let's say it drifts to $90 or $100 by year-end. But nobody trusts it for actual physical settlement. All real physical silver trades in Asian markets at substantial premiums, $130, $150, maybe to $180 depending on form and delivery location. The West continues trading paper derivatives that are nominally backed by silver but rarely settle physically. The East trades actual metal with full allocation and delivery. 2 markets, 2 prices, permanent disconnect. Western investors stuck in SLV or COMEX contracts slowly realize they're holding claims on metal they'll never receive. Eastern holders sit on physical reserves that appreciate in both dollar terms and strategic value. I'd give this scenario 30% probability, and it's the most dangerous for American retail stackers because you won't get a sudden crash to wake you up. You'll just gradually realize your silver position is worthless paper while the real metal trades elsewhere at prices you can't access. Now let me bring this home. If you're holding physical silver, bars, or